What if I told you that you could make a mistake that cost you $1 million, and you wouldn't even realize you were making it? Well, that's the real story we're going to break down today. We're going to uncover 5 of these quiet, subconscious beliefs that can absolutely sabotage your wealth, usually without you ever knowing a thing.
And this isn't just some random, made-up number. This is the potential cost of doing nothing. It's what one person calculated he lost that on by making just a few of these mistakes in his early 20s. It's a pretty powerful reminder that the beliefs we don't even know we have can carry a massive, massive price tag.
So that's really the question I want you to ask yourself today. Think of this explainer as kind of like a mirror. We're going to help you look for these silent wealth killers and see if maybe, just maybe, they're secretly at work in your own financial life. All right, let's get right into it. We're going to explore 5 key areas: the trap of always chasing quick riches, the financial fears we might have inherited without realizing it, the real danger of hoarding cash, the huge influence of our social circle, and finally, what it truly means to be safe with your money.
Okay, so our first wealth killer is a mindset that is just everywhere today, right? In our culture of instant gratification. It's this belief that slow, steady wealth building is boring, and if you can't get rich overnight, why even bother trying?
Let's take the story of Humphrey Yang. So he grew up in Silicon Valley, right around the time Facebook had its massive IPO. All around him, you had people in startups becoming millionaires, like overnight. And that created this really powerful belief in his head. The only way to get rich was to win the startup lottery. Slow, steady investing? That just seemed pointless in comparison.
And here you can see the direct result of that belief. For 5 absolutely critical years, from age 21 to 26, that mindset led to complete inaction. He invested 0, nothing. He calls these his lost years, a time when the incredible, unbelievable power of compounding was just completely left on the sidelines.
And this chart, wow, this is where the cost really hits you. That roughly $31,000 he could have invested over those 5 years, by the time he retired, that could have grown to over $750,000, maybe even a cool $1 million, just by being in a simple S&P 500 index fund. That's the real price of thinking investing is boring.
And, you know, that first mistake is so often connected to this second one. Because where do we even get these ideas about money? Well, a lot of the time, it's from unconsciously adopting the financial fears and habits of our parents. This was basically the mantra in Humphrey's house growing up. His father, he grew up in poverty during wartime, and he developed this deep-seated scarcity mindset. He hoarded cash. We're talking as much as 35 grand in a checking account, and avoided spending money, all driven by this constant fear of not having enough just in case.
And that fear, it was transmitted directly to him, and he didn't even realize it. He just soaked up that behavior like a sponge. He avoided investing because it felt too risky, and he kept huge amounts of cash on the sidelines because that's what he saw his dad do his entire life.
So how in the world do you break a cycle like that? For him, the big turning point was learning to trust the long-term objective data over his inherited emotional response. Seeing the consistent historical returns of the market, that was the logic he needed to finally conquer the fear. And this brings us right to our third mistake, which is a direct result of the first 2. It's the habit of just accumulating cash without a specific purpose or any kind of plan for it.
So by the time he was 26, even after he'd started investing a little bit, he had racked up nearly $60,000 in savings. But here's the problem. The vast majority of that money had no job. It wasn't working for him. It was just sitting there, idle.
In this breakdown, this is really the aha moment. Once he set aside a proper emergency fund and a small buffer in his checking account, he was left with over 40 grand that had no mission. It wasn't for a house, it wasn't for a car, it was just there. And every single day, inflation was silently eating away at its value.
So the key is to get intentional. This is the fix. Calculate exactly what you need for emergencies, assign a clear goal to every other dollar you're saving, and then you put the rest of it to work by investing it. You have to remember, money without a job is just a lazy, unproductive employee.
All right, this fourth mistake is one of the most subtle, but it's also one of the most powerful. It's all about how we let our social environment subconsciously put a cap on our financial growth.
When he looked back at his early 20s, he had this huge realization about his friends. All their conversations were about weekend plans and video games, but they never ever talked about money or investing or building wealth. It created what he calls an invisible financial ceiling, where the whole idea of investing just wasn't part of their world.
The power of changing your environment became crystal clear when he started a new job as a financial advisor. I mean, suddenly, he's surrounded by people talking about markets, portfolios, and rebalancing all day long. That constant exposure made learning and actually doing something feel completely natural.
And that brings us to our final and maybe the most common mistake of all, fundamentally misunderstanding what financial risk truly is.
His main fear, like it is for so many of us, was losing a huge chunk of his money in a sudden market crash. The memory of the 2008 financial crisis was still fresh, and that anxiety is exactly what keeps so many people just parked in cash, thinking they're playing it safe.
But here's the key insight, the big mental shift you have to make. Holding cash isn't avoiding risk. It's just choosing a different kind of risk. You're trading the potential for a temporary market loss for the guaranteed loss of your money's purchasing power to inflation year after year. You aren't avoiding risk, you are simply choosing which risk to take.
So if there is one key takeaway from all of this, it's really the power of being intentional. Thinking of every single dollar as an employee that needs a specific job, whether that job is for spending or for emergencies or for long-term growth through investing. That is the fundamental shift that builds real, sustainable wealth.
And that leaves us with one final question for you to really think about. Take a good, honest look at your own finances. Are your habits and your decisions driven by conscious goals and a clear plan? Or are they being dictated by an unwritten story? A story you might have inherited or absorbed from the world around you without ever even realizing it.